We're talking oil. Saudi Arabia and Russia unveiling the fresh extension to their voluntary supply cuts this morning. That was the latest catalyst for those oil prices. With us now to discuss further is Tamar Essner, Vectis Energy Partners Principal. Thanks for being here, Tamar. So as we look at the dynamics here in the oil market, first let's start with that extension of the production cuts on the part of Saudi Arabia in particular. How important is that, and how much it's extended to December? How much further could we see it extended?
Hi, Julie. Thanks for having me. I think it's significant because Saudi is going at this unilaterally. Obviously, we've seen that your prior reporter reported about Russia extending through September as well. That's all part of Russia's seasonal plan, as they always come off a little bit in September, and then that production comes back in October and November. And we think that Russia is very much incentivized to pump as much as they can right now and find alternative markets to Western buyers, because they need all the revenue that they can get as they prosecute this war in Ukraine. And they've really lost market share on gas. So they have to find it on oil. At the same time, we've seen that Venezuela and Iran have been pumping more than expected, and other countries within OPEC, which are not part of this unilateral production cut, and that historically have had much more volatile production outlooks, like Nigeria and Iraq and Libya, they've actually been quite stable with their production with their production flows. So I think that Saudi Arabia might have a little bit of difficulty because their production cuts are going to be offset by higher production from other countries within OPEC. That being said, it is really significant because they are trying to address the skepticism of the market. The rally since the lows in June has really been an unloved rally, and they're really trying to convince investors that, hey, just because there's macro concerns from an interest rate perspective and from negative headlines about China, we are here and we are fully committed. So I think it's really meant to address the psychology more than the fundamentals.
And Tamar, you mentioned China and the fact that the economic woes there are not actually reducing oil demand, but perhaps it's redirecting it. How would you evaluate that?
Sure, great question. So obviously, anytime China sneezes, basically, oil gets a cold or even the flu. The market's so sensitive to China. And the negative headlines about the property sector there have somewhat dampened petrochemical demand for oil. But post-COVID and post the lockdowns, mobility demand has more than offset that. So people are flying, they're driving, they're going to reconnect with families. And so demand in China has really been good. I think that what the market has starting to appreciate now is that while Saudi Arabia is a swing producer, China is basically a swing buyer. So they have huge inventories, huge storage. And so they basically can buy as much as they want when prices are attractive to them, as they definitely were earlier this year. And now that prices are starting to creep up higher with these Saudi unilateral cuts, China can take the foot off their gas, and they don't have to buy as much because they've built up their inventory. So I think that their demand is good, but it may start to cool off a little bit in the coming months because they have inventory to work off of.
So all said and done, where do you think oil prices go before the end of the year?
We think that the oil prices, at least for WTI, have found a decent sweet spot here, a range between on the low 75 and up to 90, maybe even a little bit past 90. But as I said, I think as China takes the foot off of the gas of their purchases and that other OPEC countries continue to supply the market, there's a bit of a balance here. Obviously, this is barring any developments on the geopolitical stage, and that's a big if. Certainly, there's a lot of opportunity for things to change with this war in Ukraine as things heat up with China. So there's a lot of big outliers and big wild cards, but the base case is that oil is sort of in a nice range here between now and the end of the year.
So can inflation then abate if oil doesn't moderate lower from this range?
We expect inflation is sort of here to stay higher for longer, and even with interest rates. I think people had thought that higher interest rates would be supportive of the dollar, and a stronger dollar would put somewhat downward pressure on oil prices. But we've seen that higher interest rates has actually made drilling more expensive, and it's made storage for oil more expensive. So it's actually provided somewhat of an upward support for oil prices. So we think that the economies around the world, particularly the developed economies, have become much more insulated from higher oil prices. So even though nobody wants to pay more at the pump, people are. And so the market and the U.S. economy, which is the most important driver, the U.S. economy is the most important driver for global gasoline, it's holding up well. And so demand is sort of steady as she goes, despite these higher prices and despite higher inflation.
Tamar, let's take this all back also to the energy producers, right? And I'm curious if we're going to see prices sort of hover in the sweet spot, the implication is that could be good potentially for energy companies and energy stocks. Is that the conclusion we should be drawing?
I think so. I think energy has been a sort of an unloved sector, even with the recent outperformance in those stocks. It's still not hasn't seen broad investor participation. So we continue to like the sector from an equity perspective. And the interesting thing is that even with higher prices, companies, management teams, and at least for U.S. companies, are really under a tight leash from their investors, and they don't really have much leeway to grow production more. So we think that the production outlook in the U.S. is strong between now and the end of the year, but we don't anticipate a huge amount of continued growth in the U.S. market. And that's actually net positive for the companies because it sort of helps keep prices supported.
Tamar Essner, Vectis Energy Partners Principal. Thank you so much, Tamar, for your perspective on all of this. Appreciate it.